Hello and welcome to a fresh new edition of our Made for YouTube series. I'm Sumaira Abidi. Today we are going to be talking about arbitrage funds, what exactly they are, what kind of purpose do they serve in your portfolio, and who's the kind of investor who needs an arbitrage fund. Joining in to talk about all of this and more is Ashwin Patni, who's the head of products and alternatives at Axis Mutual Fund. Hi Ashwin, thanks very much for indulging us again. The topic is interesting, arbitrage funds, because not a lot of retail investors would, know the nuances very well. So first up, what is the concept of arbitrage? And in an arbitrage fund, how is it used?
Yeah, so arbitrage is a little bit of an interesting product because it uses invests into instruments which are in the equity space, but it does so in a manner that it generates steady sort of performance, which is more akin to uh, let's say parking vehicles, which could be, let's say, that ultra short kind of products. So that's the sort of what tends to, in many cases for newer investors, to be a little bit of a point where they tend to get a little confused because typically in our minds, when we talk about equity or when we look at equity, it's typically the growth feature of equity and the long-term feature of equity that tends to obviously be that is associated with equity. Now, how arbitrage funds work is that within equity markets, you have a lot of derivative instruments and specifically, futures which are traded on the individual stocks which are traded in the cash market. And what arbitrage funds do is essentially take what is effectively a completely hedged position. So you buy for the same stock, let's take a stock A, the same stock you buy 100 shares cash market, which takes you a long position in that stock, and correspondingly have a short futures position for the same equivalent of 100 stock for that same stock A. What that does is makes you completely hedged on the movements, directional movements of that stock, but typically are able to capture a spread between the future price that you're able to lock in and the that comes in. This is a feature of the way the futures markets work. And this spread is essentially a carry spread that you're able to make, which is what gives this a feature which is akin to a spread or a carry or more like a yield-oriented investing rather than a growth longer-term investing of equities.
But Ashwin, this is considered to be a relatively safe product, right? I mean, if I remember, the closest comparison is to that of a liquid fund. Am I right? I mean, what is the difference or the similarity, if you can explain?
So I would say a liquid fund has because it is investing in absolutely money market instruments, and it typically the day-to-day volatility in NAV tends to be very, very low. Arbitrage, I would not compare from a purely risk perspective to liquid, but I would say more like, let's say, an ultra short or something which is more in the in that 3 to 6 month kind of space. Having said that, the key thing that people have to understand here, the risk that they are taking is not the directional equity risk. I'm maybe repeating myself from the previous point, but it's an important thing for people to get their heads around, that you're investing in equity, but you're not taking that directional risk. The risk that is there is let's say some amount of day-to-day NAV volatility risk that they take, which is of a magnitude which is higher than typical liquid funds. But let's say if your holding period is in the 1 to 3 month range, it tends to be pretty on that basis. So it's volatile on a day-to-day basis, but quite stable on a 1 to 3 month basis.
Yeah, but Ashwin, there have been past instances where an arbitrage fund has also given negative returns, right? And from what I've been told, it is a very rare event. So I wanted to understand under what circumstances, can this recur, if at all?
So typically, actually, it's a question of what period you're looking at to decide, the risk for a negative return. In fact, On a day-to-day basis, negative returns in arbitrage are very, very common. When I say day-to-day basis, means day over day. Because what happens is that typically the most common position that arbitrage funds take is in futures that typically expire within by the end of the month. So if we are operating in the month of April and have typically the future instruments that you are participating in typically would expire, most of them should expire by the end of this month. What that means is that the spread that the fund has locked in gets realized over the period of this month. So we take a position at the beginning of the month and you get a certain spread that you will achieve over a period of time, which is this month. However, in the course of the month on a daily basis, as the equity markets trade, the spread can actually by itself go up or down. It's not like a bond instrument or a debt instrument where you get a daily steady, but the spreads could actually be volatile. So you could have a scenario where day over day it could be negative, but the minute you talk about a full month, your spreads get realized. So typically then the risk of there being a downside or a drawdown are actually by and large not there. Um, Having said that, because investors don't necessarily invest only at the beginning of the month, some investors may be coming in the middle of the month, you may have some volatility around that. So typically what we recommend people is to look at this as a 2 to 3 month thing. In that over that period, actually arbitrage as a group has not really had drawdown. So it's actually quite safe when you move the needle to a 2 3 month window, and that's what we normally recommend.
Okay, now who is the kind of investor who needs, to have an arbitrage fund? I mean, are they the same people who probably would be investing in, say, a liquid fund? And what is the purpose of arbitrage in your fund? I mean, what is the function that it serves? What does it provide?
So, like I said, liquid has quite a significantly more day-to-day stability compared to arbitrage. So, at one level, at while both are in a way sort of parking products in the sense venues for people to park their surplus liquidity for a temporary period of time. But within the parking objective, there is nuance. So liquid, it can even work for very, very short periods of time. You could look at it as a 3 7 day, 10 day, 15 day, very short periods of time also liquid funds work perfectly fine. When you come to arbitrage, as we discussed in the previous question, you could have day-to-day volatility because of the way the spreads work. And typically the volatility dampens out or stays as you go beyond 1 month, 1.5 months. So to answer your question, the investors who can look at arbitrage as a parking vehicle are investors, who understand, a little bit about this product so that they don't get unduly, worried about the day-to-day ups and downs. So there's a little bit of, understanding that needs to be there. Point number two, I would say people who have at least a basic horizon beyond 1.5 months so that they don't get affected by the day-to-day volatility. But beyond that, anybody who has a parking need for, let's say, 2 3 months, arbitrage is a fantastic option in today's markets. If we see, it's a category which has been around now for almost 15 years or so. And over what we find is that if you take a 2 3 month holding period, typically this has been very, very competitive compared to other parking options in the same window that we've seen.
All right, Ashwin, thanks very much for giving us this explanation of how arbitrage funds really work and how investors can use them in their portfolio. So thanks very much for joining in. So, and for everybody who's watching, I hope this has been a learning experience, but I do urge you to do your own due diligence as well. With that, we'll wind up for this week, but do keep sending us your comments and suggestions, and we'll try and take them up in the weeks to come. Thanks for watching. Stay safe.